When a tech company casually mentions they are completely sold out for the foreseeable future and, well, supplies lagging demand by over 30%, you know you are looking at a serious AI bottleneck. Welcome to Earnings Unscripted. It is May 5th, 2026, and today we are diving into Lumentum's third quarter, ticker LITE. Just a quick reminder before we jump in that this is all just our personal opinion, not financial advice, so please do not base any life decisions on our banter. But Miro, the numbers here are just massive. Revenue came in at $808.4 million, up 21.5% sequentially, and EPS hit $2.37, well up from $1.67 last quarter.
Right, and keep in mind they are up roughly 90% year over year. That is just not normal for a mature hardware component maker.
It really isn't. And despite that, I mean, the stock had this wild, volatile ride after hours. It rallied over 86% this quarter heading into today, but then spiked down, V-shaped back past 1,000, and ultimately faded to close down around 1.6% at 960.05. So the market seems a little, exhausted today?
Well, people are taking profits when a stock nearly doubles in a few months. That happens. But if you look at the actual business, their non-GAAP operating margin jumped to 32.2%. That is a massive 700 basis point improvement in 3 months.
Yeah, that margin expansion is wild. I think the most relatable part of this whole report is why that demand is surging. If anyone is wondering what Lumentum actually does, AI data centers have basically maxed out the power grids of individual buildings. They literally cannot draw more electricity without melting the grid down.
Exactly. So the hyperscalers are forced to spread the compute across different buildings miles apart. And to make it act like one giant localized brain, they need incredible optical connections. Lumentum calls it scale across architecture. They provide the pump lasers and switches that make that happen over fiber without losing speed.
Right. It is the physical plumbing of AI. And they're the only game in town right now for some of this.
Yeah, and it definitely shows. That supply gap gives them ridiculous pricing leverage right now. But honestly, the thing that actually made me stop and reread the filing was the cash line. Their cash position exploded by $2 billion overnight.
$2 billion. Just boom. Okay, yes, the direct Nvidia cash injection. We absolutely need to talk about that. All right, let's get into the details and figure out what is really going on under the hood here.
Yeah, the $2 billion, that is not just standard capital raising. Wajid Ali casually dropped on the call that this massive cash increase was primarily driven by a direct Series A investment from Nvidia.
Oh, wow. So Nvidia they are directly bankrolling their own supply chain at this point.
Basically, yes. I mean, Nvidia needs them to build out massive capacity. Lumentum recently bought an old gallium arsenide factory down in North Carolina, and they are converting it to an indium phosphide fab, which is great because it unlocks something like $5 billion in incremental domestic revenue, but the catch is it does not actually yield product until early 2028.
Wait, 2028? But they are over 30% short on supply right now. How on earth does that help anyone in this cycle?
Well, it doesn't, which is exactly why their near-term pricing power is so absolute. Since everyone is desperate today, Lumentum is essentially extracting factory funding from their customers. And Michael Hurlston said they are talking to major customers to help, and I'm quoting here, put some skin in the game around the CapEx that we are going to try to lay out.
Okay, so they're making the people standing in line pay to build the new factory.
Exactly. Take-or-pay structures, prepayments, firm pricing floors. Lumentum is completely de-risking their capital expenditure because the hyperscalers simply cannot finish their data centers without these pump lasers.
That is just phenomenal leverage. You just walk into the room and say, sure, we'll build it, but you're buying the concrete.
Right. It's a CFO's dream scenario. But, there's another layer to that gross margin story. The massive 540 basis point jump wasn't just pricing leverage. It was also ruthless pruning. Hurston admitted they spent the last year deliberately dropping product lines that were not, as he put it, margin beneficial.
Okay, shedding dead weight makes sense. But if they cut out the legacy drag, what is still pulling down their profitability? Because they clearly are not perfectly optimized yet.
Transceivers. That is the really glaring weak spot right now. Transceivers drove over 40% of their sequential systems growth, but management openly admitted they are significantly underperforming peers on the margin line.
Which is a huge problem if that is the lion's share of your systems growth. So how do they fix a structural flaw like that?
Well, by breaking a very old corporate habit. Lumentum has historically insourced everything, complete control over their own manufacturing roofs, but now they are in the early innings of pivoting to external contract manufacturers for transceivers just to repair the unit economics.
See, I hear that and my instinct is instantly skeptical. You are making the most highly sensitive optical networking gear, $4 trillion AI operations, and you hand the keys over to a third party to save a few margin points?
Right. It introduces massive quality control risks. Semiconductor yield is incredibly fragile. If they offshore a specialized process and the scrap rates spike, the contract partner will eat those margin savings overnight.
Not to mention the delays. I mean, if you are already 30% behind demand, a botched manufacturing transition is the absolute last thing you need. It feels like they might be trading a financial problem today for a massive operational headache tomorrow.
Probably, but the reality is they do not really have a choice if they want to scale and hit the margins Wall Street expects.
Fair point. Okay, so stepping back and looking at all of this tension, you have explosive pricing power, severe backlog, a direct financial lifeline from Nvidia, but also some very real manufacturing friction ahead. So where does this actually leave their trajectory heading into next quarter?
Well, the immediate trajectory is just straight up. They are guiding next quarter's revenue to a midpoint of $985 million, which, to be fair, it would be another all-time record for them. And operating margins are expected to step up again, hitting maybe 36%.
Right, pushing almost $1 billion in a single quarter. That is kind of surreal for a component maker.
It is. And management sounded incredibly convicted. Hurlston actually had this quote on the call. He said, "Taken together, this gives us confidence that we are very much on track to reach our $2 billion quarterly revenue goal." So they are looking way past the current noise.
$2 billion a quarter? Jeez. I mean, it really just proves that this whole AI infrastructure build-out is not some temporary hardware bubble. We are quite literally rewiring the internet. But actually, wait, let me say that better. The demand is undeniable today. My bigger issue is that 2028 timeline gap. A 2-year wait for that North Carolina factory to yield product is an absolute eternity in the tech sector.
Definitely. And that is the single biggest fundamental risk here. The massive backlog makes their financials look invincible right now, but, hyperscalers do not like to wait. If fast-moving competitors in Asia figure out how to scale those pump lasers before Greensboro actually goes live, that pricing leverage could evaporate overnight.
Exactly. And suddenly you're just fighting a commodity price war. It's essentially a sprint against their own backlog at this point. But honestly, what a wild position to be in overall. They're selling the shovels, getting Nvidia to finance the metal, and forcing the gold miners to build the store.
That is actually a great summary. They just have to make sure the store does not collapse before the roof goes on.
Amen to that. All right, I think that's a wrap on our Lumentum deep dive. Thank you so much for hanging out with us, everyone. We'll catch you on the next earnings call.
Thanks for listening.
So if you want these kinds of breakdowns to just automatically show up for you, probably a good idea to follow the podcast. Just a quick transparency note, this show is generated with the help of AI, really just to see if we can use this tech to pull the actual human story out of all those dense financial filings. If there is a ticker you want us to look at next, just email us at earningsunscripted@datamadness.ca. Or grab that X link in the show notes.
See you next time.